The 2026 tax code contains specific, high-leverage updates that have been integrated into the system largely out of view of the general public. These changes originate from two massive legislative packages, the SEC 2.0 Act and the One Big Beautiful Bill Act, or OBBBA. Continuing to follow financial advice from 2024 creates a widening gap between your current trajectory and the actual potential of the updated code. Sticking to the old playbook effectively ignores new provisions specifically written for the modern earner. To bridge that gap, we are going to look at three legal mechanisms designed to optimize wealth for middle to high-earning young adults. Mastering these 2026 codes is the primary method for shielding your current income and accelerating your timeline to financial independence. Many people avoid the 529 college savings plan because of the liquidity risk. The concern is that if a child skips college or receives a full scholarship, the accumulated growth becomes trapped behind a 10% federal tax penalty. Secure 2.0 changed the math. Unused 529 funds can now roll directly into a Roth IRA, capped at a $35,000 lifetime limit per beneficiary. To qualify, the 529 account must be open for 15 years, and the moved contributions must be untouched for 5. The 529 now operates as a dual-purpose vehicle, providing a tax-advantaged path for education while serving as a secondary seed for a retirement portfolio. Most employees believe their 401k capacity is limited to the standard annual deferral amount, currently set at $23,500 for those under age 50. However, the 2026 Mega Backdoor Roth strategy pushes total contributions up to $72,000 in a single year. This works by making after-tax contributions beyond the standard limit, triggering an immediate in-plan Roth conversion. This moves the money into a tax-free environment, shielding future earnings. But the 2026 rules include a new requirement for high earners. If you make over $145,000, the Secure 2.0 Act now mandates that all catch-up contributions must be designated as after-tax Roth rather than traditional pre-tax. Calculating the difference between the standard limit and this $72,000 ceiling, the strategy shields an additional $500,000 from taxes over a 10-year period. Understanding these specific IRS limits is what separates standard savers from the ultra-wealthy. While Secure 2.0 focuses on retirement, the OBBBA legislation extends tax advantages for real estate and clean energy. The short-term rental loophole remains a primary strategy. If you provide an average stay of 7 days or less, the IRS reclassifies the property, potentially bypassing the passive activity loss rules. By maintaining a material participation log to prove active management, you can use resulting real estate losses to offset the taxes on your professional salary. Homeowners can further reduce their bill through the OBBBA's $10,000 tax credit for electric vehicles and home energy infrastructure. These OBBBA provisions effectively convert major lifestyle expenses, like your home and your car, into functional tax offsets. Combining the 529 pipeline, the Mega Backdoor Roth, and the real estate offsets creates an integrated wealth system for your income. Your first step is to verify if your current employer's 401k plan allows for after-tax contributions and in-plan Roth conversions. Then review the updated 2026 eligibility for health savings accounts. Utilizing these mechanisms requires active intent and a commitment to detailed record-keeping. It is a process of managing the mechanics of your wealth, not just the balance in your account. Financial success in 2026 is determined by how well you adapt your playbook to the current code. The rules have been updated. The choice to use them is yours.